I'm Matt Bichard with REIT.com here in Washington, D.C. for NAREIT's Washington Leadership Forum. Joining me today is Mike Barnello, the President and CEO of LaSalle Hotel Properties. Mike, thanks so much for joining us.
Thanks, Matt.
Now, your company's coming off a very strong 2013, where you posted records in ADR, occupancy, RevPAR, EBITDA. What drove those results, and what can you do to top that performance in 2014?
Well, the results were driven really by a couple of factors. I mean, certainly the performance of our hotel operators. They did a fantastic job taking advantage of great conditions. And when they did that, they were able to move rate up, which obviously moves RevPAR, and our asset management team. So between the two of those guys, they were working tirelessly to become more efficient on the expense side, and as a result, we had fantastic margins. When we think about where we are in the cycle, we're in really a great position from a supply and demand perspective, which really favors the owners and the operators. And as such, we're able to take advantage of the good supply-demand metric and push rates as much as we can. When you think about our markets, most of our markets are actually at peak demand levels. And on top of that, a bunch of those markets actually have very little supply coming online. So when you ask about where we can go in 2014 and beyond, we're positioning ourselves to continue to raise rates. Obviously, that'll translate into continued RevPAR growth. And if we can continue to do that, then we'll obviously try to minimize the expense growth at the same time to maximize the EBITDA margins. So we think we can continue to do that. When we think about where we can be relative to peak numbers, I mean, it's true that 2013 was peak in the metrics that you mentioned, but when we look at our portfolio on a pro forma CPI inflation adjusted basis, we're actually well below the peak in a number of metrics. So when you think about our average daily rate, for example, while we hit the highest ever reported average daily rate in 2013, if you adjusted that for the hotels that we actually own today, and then adjusted those results for inflation, our rate would be significantly below significantly above where we reported. And to us, that translates into opportunity. So we're looking to continue to grow the rate, and as we grow the rate, we feel that obviously the RevPAR will increase, but at the same time we'll become more efficient on the margin side and grow that way. The pro forma peak margins really are almost 400 basis points higher than what we achieved in 2013. So despite the fact that 2013 was a record, we have a ways to go get back to our peak margins, and that's what we're obviously striving to achieve in 14 and beyond.
Now, shifting gears to your balance sheet a little bit, I understand you've been able to issue equity as well as to extend some maturities. How do things look right now, and is there more work to be done in this area? Well,
we feel like our balance sheet is in great shape. You're right, we've done a lot of things to improve it over the years. Right now, we're very low leveraged. We believe that leverage is obviously an important way to boost earnings, but also can be very dangerous if used too much. And so right now our balance sheet sits at 3.9 times debt to EBITDA. So we're very comfortable with that. We've historically said we really wouldn't be more than 5 times debt to EBITDA, and that's been true for the last 16 years we've been public. So 3.9 times debt to EBITDA, we're actually substantially below that. We feel very good about that. At the same time, we have also brought down our weighted average cost of debt. So even though the fact that we have low leverage, the debt that we do have is actually at a very low interest rate. Our weighted average cost of debt is 3.9%. And when you look at the weighted average cost of debt plus preferreds, the other part of our balance sheet, it's just over 4%. So we feel like we're in great shape from that perspective. Last year, we also raised some preferred equity, and we're extremely proud of the fact that we raised the preferred equity at 6 3/8% coupon, which was the lowest ever preferred equity raise for a lodging REIT. So we're mighty proud of that accomplishment, and that's a result of the fact that the company has done as well as it has with the operators and the asset managers and the team that we put together. So we feel pretty pumped up about that.
And lastly, switching to acquisitions, LaSalle's been able to expand your presence in some of your key markets. How are you finding the competition for assets, pricing, and are there other markets you're looking to expand in?
The competition for assets in our markets has always been pretty stiff. That's been true really any time over the last 16 years. We started our recent buying program about 4 years ago. We bought 18 assets, and the competition, there's always been competition. And many times it's so much that the assets in the transaction go 3, 4 rounds, sometimes even more, in order before they pick the winner. When you think about the pricing itself, the pricing always looks high, and we always feel that we're paying a lot when we buy an asset because that inevitably means we won. We paid more than the next guy or the next guys wanted to pay. But it's only in hindsight we can figure out if we paid too much or too little. And based on the performance of the assets we bought during this recovery cycle, we feel very good that the assets we made have delivered in terms of their performance relative to underwriting. When you think about looking at other markets, we're constantly looking at other markets to evaluate for acquisitions. We have tended to be in the top markets. We really focus on the top 8 markets. We will look at other markets from time to time, but for the most part, we're focused on those because they have the greatest demand generators and the strongest performance over the long term in terms of the last 25, 26 years Smith Travel's been tracking it. So we're open to new markets, but at the same time, we like the performance in our current markets.
Mike, thanks so much for joining us today.
Thanks, Matt.
For more on this and other REIT news and analysis, be sure to visit REIT.com.